Dear Investment Committee, today I come to you with a unique investment opportunity in one of America's most popular companies, Netflix. Over the next couple slides, I will guide you through evidence that supports building a position in Netflix, starting with Netflix's strategy and response to evolving industry dynamics, a high-level analysis of their financial solvency, and key financial valuation metrics. The dynamics of the industry have changed, and the streaming wars have officially begun. Content previously available to Netflix via licenses are harder to come by, and content that's still available is licensed at premiums due to increased demand. Netflix responded to these challenges by investing heavily in original content to expand their library. Popular Netflix originals such as House of Cards, Black Mirror, Orange is the New Black demonstrates Netflix's ability to create successful original content. Netflix spent a staggering $17 billion in content assets in 2021. They were able to finance these expenditures by the issuance of debt. For comparison, Disney spent $1 billion on original content for its streaming service in its first year. Given Netflix's one revenue stream versus Disney's various lines of businesses, many skeptics are questioning the solvency of Netflix going forward. While the issuance of significant levels of debt can be unsettling, especially if Netflix's ability to meet those obligations are uncertain, Netflix's future is contingent on building a library of highly in-demand content. Netflix's debt dramatically increased from 2016 to 2020. In 2016, Netflix reported debt of $3.3 billion, and by 2020, the debt ballooned to $18.5 billion. Despite the massive increase in debt, Netflix's long-term solvency ratios are trending in the right direction. Debt to equity decreased from 181% in 2017 to 114% by 2021. Financial leverage decreased from 531% in 2017 to 281% in 2021. And EBITDA in 2021 was 9 times greater than interest expense. Additionally, Netflix became more efficient in exploiting their assets for economic benefit. Return on assets increased from 15.6% in 2017 to 32.3% in 2021. These factors contributed to higher retained earnings, which in turn has improved Netflix's capital structure and financial position. After reporting a disappointing first quarter in 2022, the stock plunged 35% in one day, closing at $226 per share on April 20th. The main driver of Netflix's collapse in valuation was from a net decrease of 200,000 paying subscribers during the first quarter. This was the first time since 2004 Netflix reported a decrease in subscribers. In addition, management also provided weak guidance for the upcoming quarter, anticipating a loss of 2 million subscribers. Management attributes the loss in subscribers from increased competition in the video streaming market, political instability between Russia and Central European countries, and the widespread presence of password sharing. However, the loss is not indicative of declining demand, but rather the natural evolution of a company competing as a maturing business. While reporting lost subscribers isn't a positive, the news isn't as bleak as what the market's reaction was. The reason Netflix lost 200,000 subs during the first quarter is due to Netflix's decision to remove its platform from Russia. Russia aside, Netflix had a net gain of 500,000 subscribers. This would suggest demand is holding constant or even slightly increasing versus declining from the presence of competitors. Additionally, management did emphasize that while they do anticipating subscribers in the next quarter, they project net gains in subscribers by year-end. The biggest challenge for Netflix is figuring out a way to monetize users who borrow login information to access content. According to management, Netflix believes there are approximately 100 million households worldwide that have access to Netflix without paying for the accounts. Netflix is by no means a perfect company, but at its current price, it is undervalued. EPS has never been higher at $11.24, and their PE ratio has never been lower at $19. Netflix isn't in free fall. Fluctuations in subscribers is part of the cyclicality of a maturing business and shouldn't be the only determining factor in the valuation of the company. Their financial statements show increases in profitability, margins, return on assets, return on equity, and declining financial leverage year over year. Yes, there are challenges ahead, but Netflix is a good investment for the investment committee to consider building a position in. Thank you very much for listening to my presentation.